Slumping real estate prices is making Bank of Canada rethink about their interest rate hike. Stay tuned to find out exactly what is happening right now. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. Now we are going to go through some interesting articles that are saying that Bank of Canada needs to halt increasing their interest rate hikes right now because the housing market is already slowing. That is article number one. Article number two we got is that the housing market is stalling. It's a different take on the same article, but there's going to be some interesting GDP numbers I'm going to talk to you about in that segment. Then we're going to also talk about, surprise, surprise, the OSFI may change their stress test because the housing market is slowing down. This is what I keep saying. Canada's GDP is still reliant on real estate. When there's some kind of slowdown, we're going to start seeing seeds being planted already, and it's happening way faster than even I would think. Then you got how much money you need to actually buy a home in the GTA. And then the last one is CPI, the Consumer Price Index is slowing down, meaning the inflation rate is slowing down. I'm going to go through that. But let's get to the first article over here. We got interest rate trajectory will depend heavily on housing market, Bank of Canada deputy says. Thanks, Sherlock Holmes. Thanks for pointing that out, as we didn't know that. But it's the narrative that was driven before where it's saying, hey, look, we're going to increase interest rate. It's not going to affect the bottom line for end users in the housing market, but realistically it does. But that was Bank of Canada's thought process. Who would have thought, right? Eye rolling back. But their whole thing right now is that they're trying to get the economy back to, like what we were saying before, the 2 to 3 neutral rate. And I still don't understand why they need to have this neutral rate because, let's be real, inflation's at 5%. Even if you get to the highest neutral rate, you're still below, meaning that interest rates are in real terms are still negative, meaning that to borrow money, it's still negative and it's going to make asset prices go up. That's the problem. So I don't know why they keep harping at this, but to each their own. But over here, they're saying that the housing market has slowed down in April, which is normally where we start accelerating because we're going through spring market. And because the response of the slowdown is they're slowly starting to think that it's due to interest rate. Again, thank you, Sherlock. Now they're contemplating whether they should continue this interest rate hike. Now, the question you're going to be asking me is like, are we going to be seeing another interest rate hike in June? I think that one's definitely guaranteed on June. But what we're going to see afterwards in July and maybe like August, September, we'll see, because it already sounds like they're planting the seeds of not trying to, slow down the housing market, which is wild because if you remember, these interest rate hikes were just starting to happen in March. It is May. It's been like 2 months, and now they're already planting seeds for it to reverse. Wonder why. These guys. All right. The next article. Post-haste, the way housing market is stalling, the Bank of Canada may have to hit brakes sooner than expected. Again, another way of someone dropping hints that they're not actually going to increase the rates anymore. Now, this perspective is written from someone from RBC as an economist saying that housing sales fell 26% in a lot of the big areas and the sharpest decline since the late 80s. While that is correct, the prices are now well below the 10-year average in April, which is, again, very abnormal. You can check out the video I did up there. But the challenge here is that because sales come down, you have to understand how it affects the tax revenue in the city of Toronto, right? Because most of the money in the city is from development. And when the market slows down, developers don't sell any projects because it's just not a good market for them. Also, when there's less properties transacting, it means that there's a lot less municipal land transfer tax and provincial land transfer tax, which means that the province is starving of revenue. And obviously, it's political suicide to increase the property taxes or increase the rate hikes. This is why they have to rely on real estate to grow the economy because so much of it is reliant on real estate. And when sales slow down, that's a really big component of the GDP. Now, they also talk about how here, Calgary, Edmonton, they're reversing back to their pre-pandemic levels. I'm not sure what they mean by the levels, whether it's sales or prices, but everyone's got a different skew in kind of what the prices are, what the sales are. What I can tell you is sales are down 40% from last year, which last year was the highest record and we're really slow. From month to month, we're also not doing very well. And then in terms of pricing, we're actually down like 3.5% from last month. And the last time we saw prices actually come down this much was about 2017 when we got the foreign buyer tax. So going from a month to month dropping this much is a pretty significant amount, right? So you got to be careful. And now what I highlighted here is that saying this is the worst drop since the pandemic in terms of sales, which is true. Now in the chart, I'll try to put back over here, pandemic's like this, and then we're like this, and then regular is like this, right? So obviously less transaction, less sales, less momentum in the real estate market. Now, one of the things that really kind of blows my mind, and they're trying to extrapolate this, is that they're saying that they're estimating the slowdown just in April alone, right? So April being 1 month, the slowdown in terms of GDP that's measured on a quarterly basis is dropping 0.2%. Now, to put that into context for you, right, the GDP was actually up 1.6% in the last quarter of 2021, meaning that a 0.2% decline in GDP is equating to about 12.5% at a rate of change growth, or say decline, meaning that just because we had some slow sales now, that GDP is down around 12% from last quarter. Just think about that. That's wild. That's why I keep saying Canada, especially GTA, is so reliant on real estate that a slowing housing market is going to affect the overall economy, which is what the first two articles were talking about, right? Which is absolutely bonkers. So the question becomes, are we going to continue seeing interest rate hikes at some point, or are we not, right? Obviously, the interest rate hike is to fight inflation, which I'm going to talk about a little bit later, but you can't affect the ports and the war in Ukraine on the cost of these, or the supply of these things that we need, like these commodities, just by raising interest rate hikes. But if you don't keep the rates high, housing rates are going to go ballistic, like we saw in the last 2 months. But at the same time, if we increase them too much, housing comes down and affects the economy. So it's kind of like, lose-lose situation for a lot of the central banks. And that's what I'm saying. Like, at some point, something's going to break, and we're going to have to either reduce interest rate hikes or keep it flat. And we're already seeing signs of the crack, like I said last episode, or even like them dropping seeds and planting seeds that, hey, look, we may not increase interest rates as much. But again, I still think we're going to have one in June. Now, here's the next interesting thing. So stress test, the OFSI, which controls the stress test, it's a federal kind of mandate, saying that, look, we are starting to see that the cost of borrowing is increasing the housing and starting to cool across the country, right? Because they look at entire stats. As of right now, the Korea stats are out, and they're not looking good. I think they're down like 12.6% in terms of sales. Prices are down a little bit as well. I'll try to put a chart up over here. I just don't have it in front of me right now. So the thing that I highlight here is that they're going to now be open to kind of changing the frequency in which they change the stress test, right? So they're saying, hey, if something's changing earlier, we're going to open up that option for us to change the stress test. So for anyone who doesn't remember, obviously last year in 2021 in June, here we go, it says last June, they tweaked the stress test so that increased a little bit. And now what they're saying is, hey, look, the housing market's slowing down. We obviously need to stimulate the economy. We're going to have to tweak the stress test a little bit more so people have more buying power and can continue buying houses to continue stimulating the economy. And that's another form of kind of policy controls or government intervention that is changing the real estate market, right? It's absolutely wild. So I talked about this previously about how I think the market's going to completely come to a grinding halt or even crash once the variable test is higher than the posted rate, which is 5.25%. We're not quite there yet, but now what they're indicating is that if you're getting a fixed, you're being tested at 6.19%, right? Because it's the contract plus 2%. And we talked about that. The variable right now, if you're doing contract plus 2, it's still under the 5.25. So when variable is contract plus 2%, it's over 5.25, that's going to affect everyone's total buying power because everyone's going variable right now to get the most money possible, because if you get fixed, you don't qualify anymore. So now what OFSI is saying that they're going to try to maybe change the stress test a little or tweak it so that people still have the buying power. So what that probably entails is they may move the goalpost on you, like what all governments seem to be doing the last few years. So you're still able to qualify for more money, whether it's on the fixed or on the variable. So they're going to probably move the goalpost of the posted rate. So the interest rate that you're qualifying for is higher, but the banks are still willing to give you more money based on the stress test. So this is all the little things that they're tweaking on the demand side. And because they tweaked the interest rate hike 2 months ago, starting in March and then in April, they reduced the demand. Now they're like, that was too much. Now let's tweak it a little bit, make things a little bit more affordable. Let's make the stress test easier, not as stressful and not as hard to pass, right? And that's what OFSI is basically saying. It's absolutely wild that it's been 2 months again and they're doing all of these things, right? So if this is the type of real estate content you enjoy, make sure to help us spread the knowledge out there by smashing the like button and subscribing to the Prime Power channel. And if you're looking for some real estate help, whether it's buying, selling real estate, because we put out all this information, you're like, I want to work with guys who actually know what they're talking about and have good experience, you can book a call with me using the link right here. It's www.chatwithzen.com. So let's move on to the next article here, which is Toronto Star. How much do you need to earn to buy a home in Toronto? Even more than you think. Great headline, Toronto Star. Bravo. Bravo. Again, probably more than what most people think, but definitely not more than what I think because I already knew the answer. But let's go through the article. So you can see here that the average home in GTA has reached keyword reached 1.25 million April. So when you're trying to make things sound really expensive, you're not going to say, hey, prices came down from 1.3 to 1.25. It's going to be, it got there, right? So again, bravo, well way of reframing it, Toronto Star. But the idea here is that you need about $223,000 to qualify for a home, which is absolutely true. My whole general thing has been, you can buy about 5 times what you make gross income, right? So if you need to buy a $1.25 million home, you need about 5 times that income, which is around $250,000, give or take. Plus, you need the 20% down payment, especially if you're over $1 million. So in this case, you need about $225,000, right? Probably missed the math at some point. And prices have actually gone up, right? So that's saying that now you need about 233 today, as opposed to what it was 6 months ago. Now, what I'm going to point out to you is that according to StatsCan, as of 2019, the median after-tax income for non-senior families was $93,000. I want you to keep this in mind because it's after-tax income, which means that it's not necessarily correct. Again, it's the framing of this article because when you go and get a mortgage, it's based on your gross income. So if you're making $93,000 after tax, you're probably making $140,000 before tax, right? Which is well above what you need. So if you need $223,000 for you to buy a home, 2 people make about $110,000 each, that's fine, right? But again, in a family where your after-tax income is 90 or like gross income is 150, it's still very, very hard for you to buy a home. And this is kind of the situation where they're saying that you're now spending about 70% of your pre-tax income, so gross income, on home ownership, which is absolutely ridiculous, insane. Because if you think about it, if you had a really high tax bracket and you're paying 30% tax, you basically have no money after you pay your mortgage. And that is the problem in a market we're in right now. And people always ask me like, hey, Zhen, where are all these people with money trying to buy the home? And here is the answer. Most people aren't buying these homes straight up right away on their first home. So these numbers are assuming that you are buying your first home and you are doing 20% down and it's 8% on $1.25 million mortgage. Now, most of the time at a $1.25 million home, that's a semi-freehold. Yeah, it's a freehold home that's semi-detached, probably east, north, or west in Toronto, which is 3 bedroom, 1 bath, maybe with a parking, right? Now, in those type of instances, most people are moving from a condo into the freehold home, to semi, right? So if you bought your condo for like $400,000, you sell it for $700,000-800,000, and maybe you exit with $400,000, you're getting $800,000 mortgage as opposed to $1 million. So it makes the numbers work a lot easier. Very rarely is someone going to go from no home to their first home, which is the average price of $1.3 million. You generally go into the entry-level market stuff, which is the condo. So Toronto condo right now is like $830 in GTA. In Toronto, GTA is like $700. So that's easier to get into because you just need about $120,000 to $150,000 to get in. But for everyone else, it is very, very difficult to get in unless you have the help of mom and dad, which a lot of people actually do. Because if you've been in the real estate market or your family has and you've paid off your mortgage and your asset has like tripled in price in the last 10 years, yeah, you're going to be able to borrow some money and pass it on. And that's kind of the generational wealth transfer that we're seeing right now. So unfortunately, you just gotta have rich parents or work really, really hard. And when you work really hard, you have to work smart as well, because the whole go to school, get good grades, have upper middle class income, buy a home, start a family, I think that's out of the water. It's just gone. It's kind of been gone for the last 5 years. And that's why I'm saying like the whole affordability to home price and the index for it, it makes no sense anymore anyways. All right, so let's move to the next article. We got US consumer prices still increasing at uncomfortable rapid rate, the pace. So depending on how and where you look at this article, some will say, hey, prices are still really high. Some will say, hey, it's coming down, right? So effectively, the rate right now is 8.3. I think it was like 8.5 last month. So if I were to frame it in a nice way, the inflation is coming down. But if I were to frame it in a bad way, inflation is still at 8%, right? So what I did over here is I highlighted this important part. No matter how much people do work on the interest rate, you can't affect the shortage that's caused by Ukraine war and also all the ports being shut down in China. So, central bankers can't control that. But what I did want to show you here is that this is the rate of inflation in US. And I know some of you will be like, hey, Zhen, why you show me US data? Again, Canada is the 52nd state. Economically, we are just US's hat. So we follow them. If interest rates go up, we generally follow them like almost lockstep. Very rarely do we not follow the US. So if their idea is to fight inflation with higher interest rate, you can see here that inflation right now is coming down from its peak. And I was saying this in the last little bit that, hey, we could probably see a slowdown in the rate of change for inflation. And the reason I had that thought was because you can see in April last year, you can see that we went right up. And when you kind of compare year over year where it's constantly going up and we're going up, the change is going to go look really fast. But in the next little bit here, it kind of flatlined. So if inflation stays the same and kind of levels off there, the rate of change hasn't actually moved. So it looks like inflation is coming down, because you have to remember all these numbers is the second derivative, which is acceleration or deceleration. It's not the actual amount, right? So I'll give you an example. If gas is $2 a liter right now, and if inflation is called 10%, next month it's gonna be $2.20. But if inflation was 2%, it's $2.02. It doesn't get cheaper. It's just that it doesn't increase as fast. You see what I mean? So what you're thinking of if it gets cheaper is deflation. And central banks think deflation is a terrible thing. I don't, but that's just how they measure. So that's why they always have this neutral rate that I talked about in the beginning, where they want it to 2 to 3%. So if you apply the whole $2 gas thing to 2 to 3%, gas next month at the neutral rate is still $2.02 or $2.03. You see what I mean? But if we're going at flatline and 0%, it's still $2. So for you to have gas below $2, you need deflation. Slowing inflation is disinflation, right? Again, not to get all technical on you, but that's kind of what the framing is trying to allure you to understanding and thinking that it's slowing down. But prices aren't coming down, unfortunately. They're just going to stay this way. They're sticky in that manner. Now, I'm not saying that gas prices aren't going to come down, because obviously a lot of things affect that gas price. I was just using gas as an example for you of how these CPI numbers are measured. And the reason why I'm trying to give you an idea of how this stuff is, actually, discussed is that if we're using interest rate, which affects the housing market, to, increase or decrease based on inflation, because, the war on inflation is real. If the next little bit inflation has already peaked and we don't need to increase rates as much, therefore, isn't it more bullish to be in the real estate market? Because they're going to slow down the rate hikes, right? You see what I mean? This is exactly why I'm trying to talk about this stuff. So if the next little bit, the interest rate is going to stay flatline, then they'll be like, hey, we won, we beat inflation. It's now back to the 2 or 3% that we're targeting, but it doesn't mean prices have come back down. See? Now, I did steal a chart here from Lynn Alden. This is a similar chart, but she put a little red dot in every single aspect here, and each red dot represents where US had a recession. Again, we follow US, we are the 52nd state economically. So you can see here that when interest rates rise really quickly, in most instances, they cause a recession. And how they fix the recession is they drop rates to stimulate the economy. Now you can see that general trend here is that the interest rate at which it's caused a recession keeps getting lower and lower. And the reason for that is there's too much money. We're in a giant Ponzi scheme. There's too much debt in the system. This is why I've always been saying, I think they're going to increase interest rates. I don't know how much. I was wrong in the beginning of the year. They did a little bit more. But at some point, they're going to have to reverse course because there's just too much money in the system, right? The fiat system is a Ponzi scheme. Somehow saying the real estate market's kind of Ponzi scheme. It's all backstopped by the government. So where you allocate your assets for investment is up to you. And hopefully this gives you an idea of how I'm seeing the market. Now, I'm not saying that we're not going to get the interest rate hike in June, and I still think we are, but they're already planting seeds about, we have to slow it down because the housing market's slow, or we're going to, hey, we have to change the offset stress test because we need housing to drive the economy to grow. See what I mean? I'm long-term bullish. You just got to ride up the short-term volatility of the real estate market right now from the interest rate hike. So if all of this makes sense to you, then you'll probably have a good idea of how to apply your own critical thinking to where you are with your assets and what to do in real estate market. For me, I've always just been long real estate. As long as the properties pay for themselves, I'm okay, right? Because I'm not kind of riding the speculative wave. I'm just holding an asset for as long as possible because I think there's a good chance that's going to go up in price or the tenants are paying it down for me. So I'm winning regardless, right? But everyone's situation is going to be different. And that's why everyone talks about all these kind of crazy rate hike swings causing the market to go up and down. But if you're good at what you do, then you can make money either way of the market. And that's kind of trying to allude to and kind of give you a more bigger picture of what I'm seeing right now. Now, if you want to work with us and our team because we have a good understanding of what's happening in the market, plus some of the stuff that's happening in the economy and how we're positioning our own portfolio, then you can book a call with me using the link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.